Hello everyone, my name is Harsirat Kaur and I'm professor for your course Introduction to Finance. So today we will talk about the third module, which is about sources of finance. In the previous module, we covered the topic about Introduction to Finance, what is finance, how it is important, and why we use finance, why it is the most important factor in business. So finance is also called lifeblood of business because we cannot think about any operation in the business without finance, because money is the most important thing in business. So that's why finance and financial management is very important, and the knowledge of handling finance is very important because, for example, being financial manager, you must have knowledge where you have to invest and which cost you have to cut off. So financial management is necessary, and proper knowledge about it is most effective and most important. So, introduction. So finance. Finance is also called lifeblood of business concern because in every business there are different departments. So different departments like marketing department, R&D department, sales department, and other departments as well. So in marketing, when there are anything, for example, if they have to run some campaigns. So when they have to run some campaigns, they need some budget, right? If they have to do advertisement or if they have to collaborate with the press. So everything needs money, right? Everything needs finance. However, if we talk about out of the business activities, even in our day-to-day life, we do a lot of financial activities, right? So all these activities are being performed by finance, right? By finances. So finance is like a blood in the body. It's similar to the blood in the business. So it's called lifeblood of the business. That's why it is very, very important. So first of all, we will talk about long-term financial requirements or fixed capital requirement. Long-term financial requirements, or also it's called fixed capital requirement. It is the finances, the money that the business needs in order to do fixed operations. For example, buying, purchasing of a fixed asset. So it means long-term financial requirement means the finances needed to acquire a fixed asset like land, building, purchase of plant, purchase of machinery. So that's what makes it to be called fixed capital requirement. So when we need money for acquiring a fixed asset, that requirement is called fixed capital requirement or long-term financial requirement. Okay. Okay, so the next is why we require finances for short term. So short-term requirements of finances are which are being used in day-to-day activities or day-to-day expenses like procurement of raw material, payment of wages. So it's all about day-to-day operations, day-to-day expenditures. So this kind of expenses when we do, and the finance that we need in order to meet this kind of requirements, that point is called short-term financial requirement, or which is also called working capital. So the amount of money, the amount of finances that we need in our day-to-day life in order to run the day-to-day operations, day-to-day expenditures, for example, payment of wages, payment of salaries, right? Procurement of raw material, all these activities are being done by the use of finances, and the finance that is required for that, and the requirement is called short-term financial requirement. Another topic is about sources of finance. So sources of finance means the way for mobilizing various sources of finance, how we move money in the company. For example, in order to meet long-term requirements and in order to meet short-term requirements, how we move the finance, how we move the money in and out of the company. For example, we have uh, discussed about financial statements, cash flow statements. So cash flow statement tells us about where do the money comes in the business and comes out of the business. So how we are raising money, what are the sources of finance that we are going to discuss in today's session. So let's dive in. Okay, we start with it. So the sources of finance can be classified on the basis of periods. So we can raise funds for long-term period or for short-term period. So long-term sources of finance are equity shares, preferred shares, debentures, long-term loans, fixed deposits. So these are long-term sources of finance. So long-term sources of finance helps us to fulfill the long-term requirements. For example, purchase of land, purchase of machinery, purchase of fixed assets, buildings. So these long-term sources of finance help us to do long-term requirements of finance, right? However, short-term sources of finance help us to generate finance with the short-term sources. For example, if we take short-term debt, short-term loans, bank credit, factoring, public deposits, money market instruments, trade credit, so getting money from the money lenders, from commercial banks. So these are used for short-term period and they have short-term period in which they have to be fulfilled. In the short-term period, they have to be paid. So they are needed in order to do day-to-day operations or short-term requirements, finances. Okay. Another one is we classify the sources of finance on the basis of ownership. So ownership means how the source of finance defines the ownership of the person who is holding that finance. For example, when we issue shares, who takes that share, who buy that share, how much is the ownership that is offered to the person who have bought it, right? So ownership sources of finance include share capital, earnings, retained earnings, as we discussed it in our first module as well, that retained earnings are the earnings that are left in the company after paying dividends to the shareholders, and that money could be used for future investments or in the company. So the dividends that are being paid to the shareholders are very important as well. So surplus, profits, borrowed capital include debentures, when the companies issue bonds, public deposits, loan from banks. So these are based on ownership. Okay. Another category is based on sources of generation. So sources of generation can be classified. How can we generate finance? So internally, finances could be generated from retained earnings, depreciation funds, or surplus. Surplus is the extra income that we have, right? External sources of finance, how external sources of finance could be created in the company. So company can issue the shares to the buyers, right? Loans from the banks, public deposits, and depend. Okay, so the next is based on the mode of financial security. So financial security, which is the mode of financial security. So what is a security? Security is a financial instrument which is also called corporate security. So corporate security is a financial instrument which is used to raise finance in the company. So we can raise finance uh, by 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 doing it from the mode of equity. So equity gives the right of ownership, debt, or other methods. So we will discuss it in the next slide. So finance maybe include share capital, debenture, retained earnings, depreciation fund, long-term finance, long-term loans or short-term loans. So these all are securities. They have their period. They have certain security of trade. So we will discuss it in the next slide. So what is security finance? So if a finance is mobilized through the issue of securities such as shares, debentures, then it is called security finance. So it is also called corporate security. So what are the characteristics of security finance? So security finance, let's say if we issue some shares, so these are the long-term sources of finance. They are also called corporate securities. Repayment of finance is very limited. So uh, for example, security finance plays a very important role in order to build up the capital structure of the company. So, what is a security? A security is a tradable financial instrument which is used to raise the capital in public and private markets. How can we raise a capital in a company? That can be done by securities, and securities are the tradable financial instrument. So there are three types of securities: equity, which provides ownership to the holder; debt, essentially loans repaid with the periodical payments and some interest over that, and could be hybrid aspects of debt and equity. So now from this we can understand, right, like security has few characteristics, like it provides ownership rights. We can raise capital by taking long-term debt or short-term debt, so that is a surety, right, that we take debt against something, and then we repay it after certain period of time. So all the elements are included in the security. So security, what are securities? So securities are financial instruments, so which has three classes: equity, debt, or other. So marketable securities are the ones which can be bought and sold, like mutual funds, bonds, certificate of fixed deposits, stocks. However, the other ones are non-marketable securities and they are non-transferable. Okay, so moving further, types of security finance. So number one is ownership securities. These are the securities which is also called share. So share is a universal method by using which we raise funds into the business. Okay, so ownership security provides ownership to the holder. For example, equity shares, preference shares, no par stake, stock, and deferred shares. So we will discuss about each of them step by step. So securities are, so first of all we will talk about equity shares. So what is a share actually? Share means the which part of for example, if we take it a example, so if we take example of a pizza, which pie of the pizza the person is holding, so that is called share. So it's a partial ownership of the company according to your share. So initially all the investments are being done in the company, and when the company grows and expands, the financial requirements also increases. So the company find out the ways to raise capital in the company. So the capital of the company could be raised by taking debt, could be taking loan, or could be offering shares to the investors who would like to invest. So there are two types of shares, ownership security finance, that we will talk about here. So number one is equity shares. So equity share is one method of raising capital in the company. So equity share is also called uh, like ordinary shares, and they are different from preference shares. So what happens in equity share? In equity share, uh, the holder have the right to take management decisions and have the right to vote, and can have their own say in the company, and they are eligible to get dividend if the company makes profit, and that decision is made by the directors and the board members in the company. So equity share capital cannot be redeemed during the lifetime of the company. The only liability of the equity shareholder is the value of unpaid value of shares. So it's like, for example, here I would like to give you one example of this thing, that the liability of an equity shareholder is the value of unpaid value of shares only. So here, if I talk about the limited liability of the equity shareholders, then the limited liability of the equity shareholder is only the unpaid value of the shares that they have not paid. That's only um, that's only value that they have to pay. For example, if they have bought 100 shares with a face value of $10, then if they have already paid $900, then the only limited liability of the equity shareholder when is $100. So it's the limited liability of the equity shareholder. So they do not have to pay the whole, but only the limited value that is being unpaid. First of all, the feature of equity shareholder number one is maturity of the shares. So equity shares have permanent nature of capital. So they do not have any maturity period. So it cannot be redeemed during the lifetime of the company. So they do not have any fixed amount of money to be paid to the equity shares. So they do not have any maturity period. So and they cannot be redeemed during the lifetime of the company. Number two is residual claim on income. So, for example, the equity shareholders have the right that when the company have paid a fixed rate of dividend to the shareholders, like the net profit that they get to the shareholders, to the preference shareholders who have fixed rate of dividend already. So but the equity shareholders do not have that fixed rate of dividend. So after paying to the preference shareholders and after minus whatever left income is available or the earning is available, the equity shareholders can claim over that. They can claim over the assets as well. So when the company winds up, they have the right to claim over the assets. So, but this right is only limited to the equity shareholders. Number fourth point is right to control. So they have a right to take decisions in the companies. They have the power to control the management of the company. Voting right. Equity shareholders have a right to vote in the company decisions. They have this right to vote. So they have the power to change or to remove any decision of the business concern. But these rights are only limited to the equity shareholders, not to the preference shareholders. Or even though they can nominate a proxy to participate and vote if they cannot participate instead of a shareholder. So another one is preemptive right. So for example, this is a legal right that is offered to the equity shareholders and that they do have is that whenever there is a possibility to purchase additional equity share in proportional to their current holding capacity, they are offered the first opportunity to buy that. Limited liability, as I already explained to you, that they have only a limited liability to pay the value that is unpaid. So if the shareholders are having fully paid up the shares, they have no liability to pay, whether in the loss of the company. So what are the advantages of equity shares? The main advantages of equity share is that they are the permanent sources of finance. So they are the permanent sources that are present in the company and they can be used for the long-term requirements, capital requirement. Number two, the equity shareholders have the voting right. They can participate in the management decisions. Number three, no fixed dividends, that they do not have any fixed dividend. They can claim for the profit, whatever profit the company have earned, they have right over that. Moreover, less cost of capital. So the cost of capital is a major factor which affects the value of the company. If company wants to increase the value of the company, they must use the share capital more, the share capital more. So equity shareholders have the opportunity to use the share capital, which has less cost of capital. However, the fifth point is retained earnings. So when the company have more share capital, so it is suitable for the retained earnings, which is less cost sources of finance while compared to the other sources of finance. So when the company have more share capital, like when the company have equity shareholders in the company, they have more retained earnings. And more retained earnings means more retained earning is the ownership, whatever is left in the company after paying dividends to the shareholders. So that is the less cost source of finance, because that belongs to the company. So disadvantages of the equity shares: number one, they are irredeemable. There is no uh, fixed amount or fixed amount that have to be paid to the equity shareholders. They can create obstacles in the management because they can disagree over certain decisions. So that could take time, and that could take a lot of sometimes can create problem in the decision making, leads to speculation. So could create speculation moments in the company. Limited income to the investors. Investors who desire to invest in safe securities with a fixed income have no attraction for the equity shares because they do not provide any fixed income, or they do not have any maturity period. No trading on equity. A company cannot trade on equity. Okay, so the next is preferential shares. So preferential shares are also corporate securities, and they are different than equity shares. So in this preference shares, the preferential shareholder have the preferential right to get the dividend, and they get back the initial investment that they have done in the company when the company winds up. So they have a fixed maturity rate and a fixed rate of dividend, and the only thing that differs them from equity shareholders is that they do not have any voting right in the company, or they cannot take the decisions in the management of the company. So these are the rights that they do not have. So preferential shares are classified into major types. So number one is cumulative preference share. So cumulative preference share means that the preference shareholder can claim for dividends even for those years in which the company have not gained any profit. So for that, they compare it with the comparison for the previous years, about a comparison of the dividends that the company have generated in the previous years, and then they can claim over their profits. Another one is non-cumulative preference shares. So in non-cumulative preference share, they do not have any right to enjoy the above benefit. So they are only eligible to get the dividend if the company earns profit, not when they do not. So when the company do not earn any profit, they do not have any right to claim any dividend. Third is redeemable preference shares. So when the preference shares have fixed maturity period, they can be redeemed during the lifetime of the company. Okay, so they have the preference of getting it to be redeemed. Okay, another one is irredeemable preference share. So irredeemable preference share are the ones that even when these shares are only get redeemed when the company goes for liquidation. They cannot be redeemed a lifetime period of the company, or they do not have any fixed maturity period. So it's not like that. Participating preference shares are those who have the right to participate even in the earning of some extra profits when the profits have been distributed to the equity shareholders. So whatever profit left, the participating preference shareholders can claim over that extra profits. So non-participating preference shareholders are the ones who do not have any right to participate in these extra profits after distributing to the equity shareholders. Another one is convertible preference shares. Convertible preference shares are the ones which can be converted into equity shares. They have a preference to do that. Another one is non-convertible, which could not be converted into. Okay, so in this slide, we will talk about the features of preference shares. So number one, the maturity period. Normally, preference shares have no fixed maturity period except in case of redeemable preference shares. So redeemable preference shares are the shares in which the initial investment is redeemable. It's redeemable to the shareholder. So another one is residual claims on income. Preferential shareholders have claim over the income. So fixed rate of dividend is paid to the preference shareholder. Residual claim on assets. So when the company get liquidation, the first right is given to the preference shareholders, and they have first claim over the assets. However, if there is any extra asset which is being left, the equity shareholders are given the distribution of those assets to them. However, the control of management is not under the hands of preference shareholders. So advantages. Number one, fixed dividends. They have fixed dividends over the investment that they have done, cumulative dividends. Even if the company do not earn any profit, they can have a claim over the dividend, which is as compared to the previous years. Redemption. They have an opportunity to get the repayment of their initial investment. Participation, they can participate in the extra profits after the distribution to their equity shareholders. Convertibility, they can convert their preference shares into equity shares. Disadvantages is that they cannot participate in decision making. They do not have any voting right. They have only fixed dividends, so they cannot enjoy more profits of the company. Expensive sources of finance. Preference shares have high expensive source of finance when it's compared with equity shares. Equity shares have low cost of capital. From the point of view of taxation, if we talk about, however, from the point of view of tax, that preference share dividend is not a deductible expense, but the interest that is applied over that is a deductible expense from the taxation point of view. Deferred share. Deferred shares are the shares which are offered to the founders of the company. So whenever the dividend is paid in the company, the shareholders who are the founders have the preferential right to get dividend even before the preference shares and the equity shareholders. However, these shares, according to the Company Act 1956, no public limited company or its subsidiary can issue deferred shares. However, these shares are offered in order to have dominance over the management by the virtue of their voting rights by the founders. So, no par shares are another kind of shares which are being issued. No par share means when the shares of the company have no face value. No face value means there is no baseline value for the company. So no single value is assigned to a particular share. So then how we calculate value of number of no par share is the real net worth of the company is divided how many parts we are dividing it into, total number of shares. So this forms no par shares. So this completes the differentiation of equity shares and preference shares and covers the topic of ownership, security, or ownership sources of finance, security finance. So I hope you have liked the video and the presentation. If you have any question, you can write to me on my email. Thank you so much. See you in the next session. Bye bye.